Hello and welcome to the House Lux Estate channel, where we delve into the intricacies of finance and real estate. Here, we aim to bring clarity to complex topics and offer insights that can help you navigate the world of finance with confidence. Today, we're turning our attention to a pivotal aspect of the banking world: regulations. These rules and standards shape the way banks operate, influencing everything from your personal savings account to international financial markets. Today, we're going to take a deep dive into the evolution of banking regulations and their impact on modern banking practices. The story of banking regulations begins in the late 19th century. This was a time of rapid economic growth, and with it came the birth of a new financial landscape. At the heart of this transformation were the National Banking Acts of the 1860s. These acts were a response to a chaotic banking system, which was riddled with inconsistencies and instability. The National Banking Acts aimed to bring order to this chaos. They established a system of nationally chartered banks which were subject to federal oversight. This was a significant departure from the patchwork of state-regulated banks that had previously dominated the financial landscape. The acts also introduced a uniform national currency, replacing the multitude of state banknotes that were in circulation. This not only streamlined financial transactions, but also helped to stabilize the economy by preventing the overissue of notes. However, the National Banking Acts were just the beginning. In the early 20th century, the United States grappled with a series of financial crises, culminating in the Panic of 1907. This was a wake-up call underscoring the need for a more robust and centralized banking system. Enter the Federal Reserve Act of 1913. This groundbreaking legislation created the Federal Reserve System, the central bank of the United States. The act gave the Federal Reserve the power to control the money supply, set interest rates, and act as a lender of last resort. These powers were designed to provide a safety net for the banking system, preventing future financial crises. In essence, these early banking regulations were born out of necessity. They were a response to the financial challenges and crises of the time. They sought to bring order and stability to a rapidly evolving financial landscape, and they laid down the foundational framework for banking regulations that would be built upon in the years to come. And so, this period, the late 19th and early 20th centuries, was a pivotal time in the history of banking regulations. It was a time of great change and innovation, setting the stage for what was to come. This period laid the foundational framework for banking regulations that would be built upon in the years to come. The Great Depression brought about a significant shift in banking regulations. This economic crisis, unparalleled in its severity and duration, left an indelible mark on the financial landscape. Before the Depression, banks were largely unregulated, and their practices often put depositors' funds at risk. But the hard lessons of this era led to a sea change in banking oversight. The year 1933 saw the enactment of the Glass-Steagall Act. This landmark legislation represented a paradigm shift, introducing a clear demarcation between commercial and investment banking. The goal was to prevent banks from taking excessive risks with the money of ordinary depositors. The Glass-Steagall Act sought to protect the average citizen, ensuring that their hard-earned money was safe from the vagaries of speculative banking activities. Another significant development during this period was the establishment of the Federal Deposit Insurance Corporation, or the FDIC, as part of the Banking Act of 1933. The FDIC was created to provide insurance for bank deposits. This meant that even if a bank were to fail, depositors would not lose their savings. The creation of the FDIC was a game changer, instilling confidence in the banking system and encouraging people to trust banks with their money once again. 2 years later, the Banking Act of 1935 further tightened banking regulations, fortifying the structure built by the Glass-Steagall Act. This legislation expanded the powers of the Federal Reserve, enabling it to adjust interest rates more effectively and control the money supply to prevent economic instability. These reforms, born out of the crucible of the Great Depression, laid the groundwork for the modern banking system. They introduced safeguards and oversight mechanisms that are still in place today, protecting our financial infrastructure and the interests of depositors. The Great Depression era was a tumultuous time that shaped the banking industry and its regulations profoundly. The regulatory legacy of this period continues to influence banking practices, reminding us of the need for vigilance and sound financial governance in maintaining economic stability. Fast forward to the late 20th century, the period of deregulation. This was a time when the banking industry underwent significant changes, largely influenced by several key pieces of legislation. First, let's take a look at the Depository Institutions Deregulation and Monetary Control Act of 1980. This act aimed to enhance competition among different types of banks and other financial institutions. It brought about the elimination of interest rate ceilings on deposit accounts, allowing banks to compete more freely for deposits. But with this newfound freedom came increased risk-taking. Next, we move on to the savings and loan crisis of the late 1980s. The deregulation of the savings and loan industry, combined with poor regulatory oversight, led to a financial disaster. Many institutions failed, costing taxpayers over $120 billion. In the midst of this crisis, the Financial Institutions Reform, Recovery, and Enforcement Act of 1989 was enacted. This legislation aimed to strengthen regulatory oversight and prevent a similar crisis from happening in the future. But the damage had been done and the industry was left to pick up the pieces. Fast forward to 1999 and we see the introduction of the Gramm-Leach-Bliley Act. This legislation repealed part of the Glass-Steagall Act, allowing banks to offer a wider range of services like insurance and investment banking. The aim was to make the industry more competitive, but it also led to an increase in risk-taking. In the short term, these deregulation efforts seemed to be a success. Banks grew larger and more profitable. But these changes also made the banking system more complex and harder to regulate. They sowed the seeds for the financial crisis of 2008. The deregulation era brought about significant changes in the banking landscape, setting the stage for the 2008 financial crisis. The lessons learned from this period continue to shape modern banking practices, reminding us of the delicate balance between competition and regulation. The 2008 financial crisis led to another shift in banking regulations. This seismic event, which sent shockwaves through the global economy, prompted a rethinking of how banks should be regulated. The crisis was seen as a result of lax oversight and risky banking practices, and there was a clamor for more stringent regulations. One of the most significant legislative responses to the crisis was the Dodd-Frank Wall Street Reform and Consumer Protection Act, enacted in 2010. This comprehensive piece of legislation aimed to reduce the systemic risk posed by banks, protect consumers, and prevent another financial crisis. The Dodd-Frank Act brought about several key changes. It established the Financial Stability Oversight Council to identify and monitor risk to the financial system. It created the Consumer Financial Protection Bureau to protect consumers from abusive financial services practices, and it imposed stricter capital requirements on banks, reducing their ability to take on excessive risk. The act also increased regulatory scrutiny of banks. Banks were subject to stress tests to ensure they could withstand economic downturns. They were required to develop living wills, plans for quick and orderly wind-down in the event of failure. In essence, the Dodd-Frank Act aimed to make banks safer and more accountable. However, the act was not without controversy. Critics argued that the increased regulation placed a heavy burden on smaller banks, stifling competition. Others felt that it did not go far enough in reining in the risky behavior of big banks. Despite the controversy, the Dodd-Frank Act has undeniably had a major impact on the banking industry. It has led to a shift towards greater consumer protection and a reduction in risky banking practices. It has also led to greater scrutiny of banks' operations and their ability to withstand financial shocks. The aftermath of the 2008 crisis brought about a wave of regulatory reforms that continue to shape the modern banking industry. As we move into the future, it's clear that the balance between regulation and innovation will continue to be a key theme in the world of banking. As we've seen, banking regulations have evolved significantly over the years. From the early days, where the focus was on establishing a framework for safe and stable banking, to the dramatic shifts brought about by the Great Depression. This turbulent period ushered in a wave of stringent regulations aimed at protecting consumers and stabilizing the economy. The era of deregulation, starting in the late 70s, marked another significant turning point. The loosening of restrictions opened the doors for innovation, but also led to risks and challenges. It was a testament to the delicate balance regulators need to maintain between fostering growth and safeguarding the financial system. Fast forward to the post-2008 financial crisis era, and we see a return to more stringent regulations, this time with an added focus on preventing systemic risks and promoting transparency. The modern banking landscape is now shaped by these regulations, with practices designed to ensure stability, protect consumers, and maintain trust in the financial system. Every phase of regulatory evolution has been a response to the challenges and needs of its time. And while the path has been complex, the goal remains the same: to create a banking system that serves the needs of its customers and contributes positively to the economy. That's it for today's deep dive into banking regulations. Don't forget to subscribe to the House Lux Estate channel for more insightful content. We look forward to seeing you in our next video.